Hello traders. I want to take some time to talk about early assignment. I would say one of the biggest fears that I hear from other traders who are just starting out selling options, whether that be selling puts or doing some kind of credit spread, is that they're fearful of getting early assigned stock and afraid that they wouldn't have the cash in their account to cover the purchase of that stock. So hopefully this video will set your mind at ease in the situations that, at least from my experience, it's not that big of a deal. At least how my broker handles early assignment. I can't speak to your broker, but I can just tell you how it's worked for me in the past when I've had early assignment. So let's just jump right in and look at some of the specifics about early assignment. So first of all, an option buyer can exercise their option at any time. Typically, option assignment occurs for in-the-money options after expiration, but it can occur before the option expires, which is called early assignment. So in my case, which is selling puts the majority of the time, any put buyer of the same option that I sold has the right to exercise it at any time from the moment they buy that option. It doesn't matter if there's still 30 days left to expiration. It doesn't matter if the option is out of the money. They have the full right to exercise it as they please. Now, they would be crazy to exercise it if it was out of the money, but they have the right to do it. And if it moves in the money, they have the right to exercise it, even though there could be several weeks until expiration. We'll look later and see why that would not be a very smart idea for them to do that either. But just know that anytime we sell options, in the case of selling puts, we're obligated to buy that stock if the buyer of the put so chooses to exercise his option early. An option should never be at risk for early assignment if it is still out of the money. Like I just mentioned, the put buyer, they have the right to do it if it's out of the money, but they would be crazy to do so. I mean, I've never had it happen to me, and I've done thousands of trades over several years. So we should never see that happen because, you think about it, if the put buyer has the right to assign shares at 90 and the stock is sitting at 100, they'd be crazy to sell me the stock at 90 when they can just go sell it to the marketplace at 100. So that's why they would never want to exercise their option when the stock is still out of the money. Option assignment happens after the market closes and is randomly assigned to an option seller. So what this means is that, if a put buyer decides at noon on a Monday that they want to exercise their put, it's not like you're going to be assigned shares immediately. You won't be assigned shares during market hours. If a put buyer wants to exercise their option, they can notify their broker that they want to exercise it, but the actual exercising of the option will not happen until the market is closed. So, if you are concerned with early assignment or concerned of getting assigned, if you closed out your option before the market closes, you don't have that risk of getting early assigned. But when the market closes, any put buyer who decided to exercise their option that day is going to be randomly assigned to any option seller who has that same strike price and expiration. Option assignment can still occur during after-hours trading. This is particularly important to note for expiration day. This is why it's always good to buy back options before they expire if out of the money. So let's say you sold a put and it's expiration Friday and it's out of the money and you think you're good to go, you're just going to let it expire worthless, and the market closes and it's still out of the money and you think you're fine. Well, if 30 minutes after the market closes during after-hours trading, if the stock drops below your strike price and now becomes in the money, that put buyer can actually still exercise their option in after-hours trading. Now, the options market is closed at that point in time, so no one can still trade options, but stocks can still be traded during after hours, and assignment is essentially trading stock at that point, right? If they want to exercise their option, they are selling their shares to you, and they can do that in the after hours market. So you could have a situation where you think you're totally fine on expiration Friday, and then Monday you wake up and you've got 1,000 shares of that stock sitting in your account. So that's why I always close my options out, even if they're so far out of the money that there's a 1% chance that it would move in the money after hours. I still want to close it out just so I don't have that risk of an after hours assignment. And plus, I want to free up my margin anyway to be able to put on a new trade. Now, from an early assignment standpoint, you could still have that same risk. Again, if it's a Monday and the market closes and it's out of the money, but that evening it goes in the money, the put buyer could still, if they wanted to, exercise the option after hours. I've never seen that happen before, but again, it's something that could happen. Early assignment can occur for any strategy that has a short option. For example, spreads, iron condors, strangles, etc. So if you're trading credit spreads, you still have a risk of early assignment for that short leg of your option because a credit spread is made up of a long and a short leg. So if the stock moves below your short strike, you do have the risk of early assignment. But with a spread, you're protected because you're protected by that long option. I'm not going to really talk about early assignment as it pertains to spreads because I haven't really made many videos about spreads, so I'm going to wait until I actually start putting out some videos explaining how spreads work, and I'll revisit this discussion as far as early assignment's concerned with spreads because they are slightly different. But just know that if you are trading spreads, you should not have to worry about or be fearful of early assignment for those as well. I mean, again, you have the risk of it happening. It's just that it's not that big of a deal, and you should be able to easily correct it if it happens. But for this video, I'm specifically going to be really talking about for selling puts. There is no advantage for a put buyer to exercise their option early. This is why there's a low risk, less than 5%, and I put Mark's statistic because that's just my statistic based on my experience. I don't have an official statistic of how often options are early assigned, but that's just kind of based on the hundreds of trades I do a year. I would say, I maybe get 5 or 6 early assignments for those that move into money. And we'll look here in a second to see why there is no advantage for a put buyer to exercise their option early. And lastly, calls are at risk for early assignment if X dividend for a stock is within the expiration. So for calls, and again, I don't sell a lot of naked calls, so it's not something that I really focus on, but they are at a higher risk of early assignment if the stock is paying a dividend within your expiration cycle. Because whoever bought that call option, they may decide to exercise it so they can go ahead and buy shares of the stock so that they can collect the dividend when the dividend is paid out for that stock. And the determination of whether or not a call buyer would do that really just depends on if the dividend is going to pay enough or pay more than what they would get from the extrinsic value of the call option they were holding. So it's not like a guaranteed scenario that they're going to early assign if a dividend's coming up. It really just depends on how much the dividend is paid, how much value is left in the option. There's some things they have to consider, but there's a higher risk for calls to be early assigned versus puts for this one additional factor. Okay, so let's look at a scenario where early assignment occurs. You've seen this spreadsheet in my other videos, and I'm just going to use the same information I used for my What's the Risk video, so the same stock symbols that I had for that one. It's just easier for me to just keep that same information. And for the purposes of this video, really it doesn't really matter what stocks we look at from what I'm trying to show you here. So I have a $25,000 account. I'm doing 3 contracts each for these 6 positions, and it's using about 60% of my buying power. If we go over to the next tab, I've modified it somewhat so that we can look at what would happen if there's an early assignment. Now, right now, the stock price is above the strike price. So in this situation, like we looked at earlier, it would not make sense for someone to exercise their option when the stock is still out of the money. Why would they want to sell it to me at 46 if they can go sell it at 48 at the current market price? But let's say we have a 10% drop across the board. So now the stock price is below the strike price. So every one of these positions are now in the money and could be at risk for early assignment. You can see just from the drop itself, I'm now using about 93% of my buying power versus the 60% that I was using initially. And so now let's look and see what happens if I get early assigned on this first position for Citigroup. Before I do it, I want to point out right now Citigroup is using up $3,585 of my margin in this example. The notional value is $13,800. This means that if I were forced to buy Citigroup, it would cost me $13,800 to do it. And right now, I only have about $1,800 of my buying power left. So obviously, I don't have $13,000 to buy this stock. But what will happen is that when I get early assigned, this buying power reduction goes away because I no longer need it anymore because I'm no longer in this option. So this buying power reduction will actually come back to me. So my option buying power will increase by that amount. But then I'm going to have a new buying power reduction from the purchase of this stock. And keep in mind that most brokers allow you to buy stock on margin as well. So I don't have to come up with the full $13,800 to buy the stock. No different than I didn't have to come up with the full amount of money to sell the 3 contracts of the stock. I only had to put up $3,500. Well, for most brokers, you only have to put up 50% of what it costs to buy the stock. So whenever I get early assigned, I'm not going to have to put up $13,800. I'll have to put up half of this amount. So I'm going to get this amount back, and then I got to put up half of this. So we'll see what that looks like. If I check this to say early assignment, yes. You can see, okay, now the buying power reduction went away for that option. I now have been assigned 300 shares, and now I have a stock buying power reduction of $6,900, which is half of this amount. So since I didn't have the $6,900 available, I've now gone into a negative buying power availability, which is going to basically be a margin call. I would need to deposit $1,511 to be able to still maintain holding this stock. So this is really no different than what we looked at in the What's the Risk video in situations where your buying power could go up above 100% and you'd be in a margin call. This is no different. We're just in a margin call now. And we can resolve it a few different ways. I can deposit that money if I would want to continue holding the shares of the stock, or I can just sell the stock. And you can see if I sell the stock, I'm going to take an $840 loss by doing so. And the way I came up with that is I'm buying the stock for 46, so 46 times 300 shares. The current market price is 43.20, so I can turn around and sell it for 43.20, and my loss will be the difference between the current stock price and my strike times the 300 shares. So I would lose $840, and I can just move on and be done with the trade, take my loss. And by doing so, this buying power reduction would go away, and I would be back to where I'd have enough buying power to continue on maintaining my current positions. You can see if I zero this out, so let's just pretend that I were to sell this stock, you can see now my buying power percentage goes back down to 78%, and I'm fine. But the downside is, obviously, I took a loss. Well, in my case, I don't want to have to take a loss on the stock. Let me put this back the way I had it. So what I do is I get back into my original put. And if you notice, I have over here the put value is 840. Notice that the put value is the same as what I took a loss in the stock. Actually, this put value would be a little more because I'm only accounting for the intrinsic value, the in the money portion of this option. It actually would be more. I just don't know what the time value in that option would be, so I can't really account for it here. But just know that whenever you sell the stock, if you get back into the exact same option you were in to begin with, you will recover the losses from that stock plus make a little extra. And we'll look at that here in a second. And the reason for that is that I know that if the stock is at 43.20, that this 46 strike put has to at least be worth the difference between the two times the 300 shares, which again comes out to be 840. So what I do in this situation is anytime I'm early assigned a stock and my buying power goes in the red, I will sell the stock, take the loss, get right back into my original put, and it's almost as if nothing happened. I'm recovering that amount that I lost. I'm right back into the exact same trade I was in the beginning. It's like the early assignment never happened. And it would be the same scenario if every single one of these stocks got early assigned. Again, we're in a really bad situation from a margin call standpoint. It's saying we need to deposit $22,000. And I think this is what freaks people out is like, oh, I don't have $22,000 to deposit. What am I going to do? And really, it's not that big a deal. Again, all you would do is just close out all these positions. You would sell the stock and take the loss. And if you were to do that, you would lose $3,870. So you had a $25,000 account. That's how much you're going to lose by having to close all these positions out. But again, if you don't want to have to take that loss and you think the stocks could still recover, if you're still bullish on the stock, and if it wasn't for the early assignment, you would have kept holding them, then why not just get back into those puts again? And by doing so, if we reverse all these and say, okay, I'm going to sell all the stock, get back into my original trades, you can see it puts us back into our 3 contracts. And we've got the same buying power reduction we had originally, which is less than the buying power reduction that's required to hold the stock. And we're still in a situation where we're not in a margin call. We're right back to where we started. So I get asked a lot, why don't I just hold the stock and do covered calls on the stock whenever I get early assigned? And it really comes down to this reason. It's because typically when I get early assigned, I don't have enough buying power to hold the stock because the buying power reduction to hold the stock is higher than what it was for me to hold the put. So I can get back into the put and be fine, but I don't have enough buying power to hold the stock. So that's why I don't do cover calls. Maybe I could have held the stock if I was using less buying power in the beginning. If we go back, I'm using 60% here, but let's say I only did 2 contracts in the very beginning. Now you can see with a 10% drop, even though I'm early assigned, I still have enough buying power to hold the stock. So in this situation, I could hold the 200 shares of the stock and do cover calls if I wanted to. So you've seen this before in my rolling options video. I just want to kind of go through the 2 scenarios again to show you basically why I do what I just explained. So let's say we have 2 scenarios. Both scenarios, the stock price is at $50. And in both scenarios, I sell 10 contracts at a $50 strike, 30 days to expiration. So I'm selling an at-the-money put with 30 days to expiration. Let's say in week 1, the stock price drops to 45 for both of these, and we would have an unrealized loss of $5,000. And let's say in week 2, the stock drops to 40, and now we would have an unrealized loss of $10,000. But in scenario 2, I get assigned stock at 50. So scenario 1 is still in the option, but now I'm holding stock at 50, and now I'm going to be down the same amount. I'm still down $10,000. The same as scenario 1 when you're just holding the option. I'm still down $10,000 because I'm having to buy the stock at 50 when it's currently trading at 40. So that would be a $10,000 loss. Again, an unrealized loss because I still own the stock. But then let's say I sell the stock at 40. So now I am taking a realized loss of $10,000. But I can sell 10 contracts of the 50 put, the very same one I had in the beginning. Now it's 15 days to expiration. So it's the same exact expiration. It's just that now I'm 2 weeks away from it versus initially I was 30. So I'm getting right back into the exact same put that scenario 1 is in. And I know I'm going to get at least 10,000. I put 10,000 plus because I know I'm going to at least get back the intrinsic value of the option, which is the in the money portion of the option. And again, it's 10 points in the money. So I will recover the loss from selling the stock. And I'm right back into the same exact scenario as scenario number 1. I'm back into the same put, and it's as if nothing happened. Now again, it doesn't mean that you're still not down $10,000. You still will have an unrealized loss of $10,000 when you do this. It just means you're not going to have that realized loss anymore. You're putting yourself back in a situation that you're in the exact same trade you were in the beginning, so that when we go to week 3, when the stock recovers to 45, you're now only going to be down $5,000, just like scenario 1. And then if in week 4 it goes back up to 50, you're not going to be down anything. You'd be able to get out of your option and not lose any money. So in scenario 1, when you were down $10,000, if you wouldn't close it out here and just be done with it, then why would you close it out here and be done with it as well? You know, when you get assigned the stock and you sell the shares, why take the $10,000 loss and move on? Because I have a lot of people ask me that, like, why would you want to get back into that put, get back into a losing trade? What's the same argument as scenario 1? Why are you holding on to this, still holding on to this position when you're down $10,000? And most people would say, oh, because I have 2 weeks left in this option. I want to wait to see if it recovers. What's the same scenario here? I want to get back into that option and wait to see if it recovers as well. I don't want to take this loss. So that's why I would then sell that put, get back into the option, and ride it out just like I would normally, rolling it week to week, waiting for it to recover. Okay, so let's look at what happens when you do get early assigned as far as how are you alerted to that. So in my case, my broker sends an email. So here's my inbox. You can see it always says option assignment alert. You can see I've only had a few this year. I had one back in February, had a couple in January. If we look at 2019, you can see, again, it's not a lot. And I do hundreds of trades a year. Now again, not all those trades go in the money, but let's say that 25% of them probably go in the money based on the probability of the money that I'm selecting. So you can see I've got 1, 2, 3, 4, 5, 6, 7, 8, 9. About 9 trades last year that I got early assigned on. 2018 was a little more. And let's look at one of these emails. If I open up this one, again, this email usually comes out really late at night or early the following morning. And it says, we want to let you know that your account ending in 6088 has been assigned the following positions. 25 contracts of Micron Technologies with the September 7th, 2018 expiration at the 52 strike. Note that your balances and positions may not be updated until the following business day. Please be aware that option assignment may cause insufficient balance or short positions that cannot be maintained. You may be required to take immediate action in these instances, which again is what I have to do because the majority of the time when I get early assigned, I do not have the funds in my account to cover holding the stock. Also, I want to show you this one in particular because you can see that it's 25 contracts. And it wasn't because my account was a lot bigger then, because as you know, I normally do 10 contracts. I really made a stupid mistake here in that I remember I couldn't find enough stocks to put on for that given week. And Micron Technologies was paying a really nice premium. So I thought, oh, instead of putting on, 5 stocks, 10 contracts each, I'll just do a couple stocks and do a lot more contracts. So in this case, I did 25 contracts versus my normal 10. And I really got burned on that. Because if you remember, I mentioned for 2018, I had a 25% loss that year. And it was because of this trade. Because I sold the 25 contracts. And if we look at a chart, here's around the time that I sold the puts. So you can see it really dropped off. I mean, it was around 52. I don't remember. Well, the email said the 52 strike price. So I'd sold the 52 strike price, and then it really dropped off. My broker, TD Ameritrade, actually called me and said, hey, you've got too many contracts on to maintain this position. We need you to close out the position. So that's why I took a loss that year, is because I had to close out the majority of my positions because I over-leveraged myself in one position. And that was just a huge mistake on my part. And that's why now you'll never see me do more than 10 contracts on a given position. If I can't find another position, then I'll just do the one trade for that week. If you guys ever see me do more than 10 contracts, I give you permission to send me like a virtual slap or something, because I'll never make that mistake again. Because again, I was up in 2018, and from taking that hit, it forced me to close it out and actually be down for the year because of that. And what really sucked about it was because if we look, MU eventually recovered back up to those levels again the following year. It took it about a year to do it, but here was the drop over here to the left, and you can see roughly a year later in September, it was back up to those levels again. I don't know if I would have held on to it that long anyway, rolling, but again, I would have had a much better chance of rolling it if I would have just done my usual 10 contracts versus the 25 and being forced to close it out and taking that loss. Let's look at a couple other emails here real quick. I just want to show you, you can see I had a few back-to-back. So that's another thing that can happen, is that once the stock gets really deep in the money, you can get assigned, and then you may fix the assignment by getting back into the put, and you could get assigned again the very next day. So if we look at this one, you can see I was assigned 6 contracts, or sorry, I was assigned 600 shares because I'd sold 6 contracts of Square for the September 6th expiration 76 put, and then the very next day, on 8/28, I get the same email again. Same number of contracts, same expiration. So what happened the prior day, I got assigned the stock, I sold the shares, took the loss, but then I got myself right back into that put again to recover that loss. And then the next day I got assigned the shares again. So I had to do the exact same thing again that day. So it's an inconvenience, but it's not something to be worried about in those situations where you're getting early assigned multiple times. And I didn't get another early assignment again for that position, because you can see on my next one's on 9/25, and it's for a completely different stock. That was for Roku. So the last thing I want to do is show you why early assignment for puts does not happen that often, and why it would be a bad idea for a put buyer to early assign. And let's take a real world example. You know, I have my current trade right now in GEOS, which is currently in the money. The stock is trading at 22.67, and my strike price is 24. So I'm $1.33 in the money, so I am at risk for early assignment right now. But this is the reason why it would not make sense for the put buyer to early assignment. So whoever bought a put at 24, they have a couple choices. So I have option 1 and option 2. And when I say option 1, I don't mean like stock option. I mean like choice number 1 and choice number 2. So the first thing they can do is they can early assign me. They can sell me their stock, and they're going to get $24,000 for that sale of their stock. Because I have 10 contracts, 1,000 shares. They would get $24,000 worth of stock, which means that I would have to spend $24,000 to buy that stock. And again, my broker would only require me to put up half of that, $12,000 to hold the stock. The reason why they wouldn't want to do that, though, is because look at option number 2. So option number 2 is they could just close out the put option they bought, and the option is currently trading for $1.90. So they could close that option out, and they would make $1,900 for selling that option that they originally bought. Then they can go sell their stock at the current market price of $22,670, and they will actually make $24,570. They're going to make $570 more by doing it this way than actually early assigning me the stock. And if you notice, the extra amount they're making is the extrinsic value of the stock. So this option is currently worth $1.90. The intrinsic value, the amount that's in the money, is $1.33. The extrinsic value is 0.57. So anytime there's extrinsic value in the option, it would not make sense for the put holder, the person who bought the put, to early assign, because they're giving up this money by doing so. Well, on my last video about rolling, what are the situations where the extrinsic value would be 0? There's only really 2 situations you'd have an extrinsic value of 0. On expiration day, so the last day when that option expires, the extrinsic value will go to 0. That's why most options don't get assigned until expiration day. To when there's no more extrinsic value left, to where it wouldn't make sense for this put buyer to do this scenario, they would just go ahead and assign the stock. The other situation where the extrinsic value would go to 0 that we looked at in the last video is the deeper in the money an option is, the less extrinsic value it has. So if GEOS continues to drop, where this extrinsic value is basically 0, then that put buyer may decide to go ahead and early assign their option. And again, we don't know why the put buyers early assign their option, because again, there's really no advantage to them doing that. I mean, whoever owns GEOS, they bought the 24 strike, assumingly to protect their stock if it dropped. But you would think they would want to wait until the very last day if they still want to hold their stock. They want to wait to see if the stock is going to recover so they don't have to worry about giving up their shares. They really just bought this for protection in most cases. But you could have a situation where maybe the person who bought this put needs cash really bad and they want to sell their stock and get out of it because they need the cash for whatever reason. So in that situation, it wouldn't make sense for them to go sell their stock at the current price when they know they can assign it to me and get a higher price of $24,000. But again, if there's still extrinsic value left in that option, the smarter move would be for them to just close the option, sell the stock at the current price, and make an extra $570 over if they'd have just early assigned me the stock. And now let's look at it from my perspective as the put seller. So same information. So we're still looking at GEOS. In this case, I have a margin requirement to hold GEOS, to hold this put of $6,439. And let's say I do get early assigned the stock. So it's going to cost $24,000, but my broker is only going to require me to put up $12,000 of margin. And right now I would have the available margin to hold the stock. So in this situation, would just decide to hold the stock and do cover calls. So let's say I did not have the $12,000 of available buying power to hold this stock. I would then sell the stock at the current market price, which is $22.67, and I would take a stock loss of $1,330. But then I would immediately go sell the 24 put again, the same exact strike price I was in to begin with, and I'm going to collect $1,900 because that's what the current value of the option is. And you can see by doing so, I'm going to recover the losses that I got from selling the stock, plus I'm getting an extra credit of $570. So really in this situation, getting early assigned benefited me because by getting back into the put, which still has extrinsic value, and since the put buyer basically gave that up by early assigning me, I can now collect that extrinsic value by getting back into the put, and it's like I'm getting an extra credit that I never would have gotten if not for the early assignment. So that's why I always say that when you get early assigned, you can always fix it by getting back into it, and you're at least going to get the amount that you lost on the stock, but usually it's going to be more than that if there is still extrinsic value in the option. Let's say that, if the stock was trading lower, maybe say it was trading at 20, and let's say that option now is going to be worth, let's say 4.01. You can see in this situation, it has very little extrinsic value, which means that it's a higher risk for me to get early assigned. And by doing it, I would only make about $10. So I'm still not losing money by doing this, but I would only get a very small credit because there's just not very much extrinsic value left in this option. And again, I want to reiterate, I'm not recovering this loss immediately. It's just that now I'm in a situation where it's an unrealized loss because I'm now collecting this premium to cover that, but I still have to wait for the stock to get back above 24 for me actually to realize the overall profit. So I hope that clears everything up about early assignment. Let me know if you still have some questions, but at the end of the day, it's not something that you should really be concerned about, or you should allow it to keep you from selling puts or doing any kind of spreads out of fear of this early assignment, because again, there are ways to fix it. But that's all I got. Thanks.